Hey guys, Alex here with Everything Utah Real Estate. We are back again in person with Oscar. It is no mystery that interest rates aren't very good right now. They kind of suck, but we have a few tips, we have a few tricks, we have a couple of ways to get around that and get your payments and your cash flows a lot better than you might think oh my gosh, then you think you can get them right now given the current market. But we're going to be going through those today. Oscar, what do you got for us?
Yeah, so when you're going out and buying a house, there's a lot of different numbers that you get presented with, a lot of different, when you're looking at different home options, things that play into how much you're going to be paying each month. So really the name of the game is how much is going to be coming out of your pocket, right? The interest rate is a number, the purchase price on the house is a number, but really the one that is the most important, I feel like, is how much you're going to be forking over each month. Because that's the one that's going to be hurting your bank account, right? So that's kind of mainly what we're going to be focusing in on. And really each home is going to be so different. And so we want to talk about how it affects your monthly payment. When homes have different things like HOAs, when homes have, when you're able to get things like seller concessions, to do different options or to getting your monthly payment lower. So the first one kind of that we want to kind of dive in to is an interest rate buy down. So basically, first and foremost, what this plays into is seller concessions, which kind of we should delve into first. So Alex, how often are you seeing seller concessions in this market?
Quite a bit. It's honestly, especially right now and going into the latter months of the year, it's going to get easier.
Yeah.
And right now it's not guaranteed. Not every seller's in the same situation. Not every seller is realistic. Not every seller has the same expectations, but for the most part, it's pretty easy to get, even substantial amounts. And here's the other cool part too, is almost every single seller is going to allow you to raise the purchase price to get extra concessions. Like for example, let's say they're going to give you $10,000 off the top, but you want 20. Okay. So what you're going to do, you're going to raise the purchase price 10 grand and you're going to ask for $20,000 in concessions. So that's one way to do it also. But yeah, concessions are pretty easy to get.
I've also seen it happen, later in the loan process as well, when the appraisal comes in high.
Yep.
And then you have kind of some more bargaining power if your appraised value comes in higher than what the sales price was on the home.
The only thing I'll say to counter that is usually you want to appraisers and appraisals, they don't give you the market value of a home, right? Basically, when you're buying a home, an appraiser is there to assess the risk of a home, right? To see, okay, can the lender loan this? Is it even worth this? Mm-hmm. So the purchase price is a target. If you want closing costs, if you want concessions, if you want something and you want to build it into the purchase price, you got to do it up front. That way the appraiser can hit that target. Otherwise, all they have to do is hit the purchase price and they're good to go. They did their job.
For sure. Yeah, definitely like waiting down the line to try and negotiate for closing costs is not the move.
It's not ideal.
That's more of like a, if possible, maybe there's like some additional you can squeeze out later. Yeah. But yeah, up front definitely is where the negotiating needs to happen. But so seller concessions is something, as Alex, as you were just saying, is something that is a lot more common, right? Back, previously 2020, 2021, that was like
is impossible.
Yeah, it was like no way in heck. You have like 50 other people, like if you walked up and you're like, and I would also like $10,000 concessions, please. They're like, well,
kick rocks, yep.
Yeah, move along. So, so that did not exist, but now it's become a lot more common, and so you can use those funds for, to cover closing costs, which is a very normal way of doing it, where you don't have to, traditionally. You can roll in closing costs into your loan with refinances and things like that. With purchases, traditionally you need to pay your closing costs out of pocket, but seller concessions can actually cover those. So money that you're budgeting in to pay for the house, if seller concessions are an option, kind of take that burden away from you. The other thing that you can do with seller concessions that is very specific to the current market are rate buy downs. And so there are two different kind of versions of those, and kind of we want to talk about the difference with those. So there's a permanent rate buy down that has always existed, will always exist. And it's, well, I don't know, I think will always exist. It's where you can put money down up front on your home to buy down your interest rate. And that is, on your locked interest rate forever. So that's a very common thing that's done. So let's say, for instance, you're at like a 7.25 and you really want to get to 7, you can put money down to get to that mark. There's one kind of, and again, that can be covered out of your pocket or included in seller concessions as part of the closing costs. One kind of risk associated with that kind of one is it's very expensive to do a permanent rate buy down. And the thing is most likely, most likely, I wish I had a crystal ball, but I'm not a fortune teller. But most likely, we will see rates decrease at some point in the next year, 2 years in the future. So as we see kind of more effects of of what the government and the Federal Reserve has been doing, and inflation really be done and dusted with. So and the thing is if you've dropped a ton of money on doing a permanent rate buy down at the beginning, you're most likely not going to be able to reap the rewards of that, because when you're putting down kind of the money to do a permanent rate buy down, it will take about 3-4 years generally to kind of recoup the savings in your monthly payment to the money that you've put down. So a permanent rate buy down, especially like a big rate buy down, I generally don't recommend. So something that's come up recently, and it within the last year or 2 years, and actually I don't think it really existed in the market since like the 80s or something very often. Like it wasn't in major usage, is temporary buy downs. So like on ones that you've worked on, how often do you see people going after temporary buy downs on homes?
It just depends on the buyer.
Yeah.
And their risk level. And just to touch on that, the reason we recommend not doing a permanent buy down is because just what he said, we're expecting rates to come down in the next couple of years. And when you do a permanent buy down, for one, it's more expensive than a temporary buy down. And two, when you do a temporary buy down, that money is basically prepaid interest that the sellers put away for you. It goes in a trust account, gets paid out every month. Whatever's left over when you refinance, let's say rates go down, year and a half a year, whatever the case is, whatever's left over actually gets rolled into your refi. So get a free refi, which is kind of cool. Yeah. And
with a permanent, is lost though. Like if you've put 5,000, 10,000 in to drop your interest rate, and then rates suddenly come tumbling down, you're like, sweet, I want to refi and drop my rate. You refi 6 months in a year, 2 years, whatever. That the money's gone. You can't recoup any money from permanent rate buy down. So
yeah. And to fully answer your question,
you're good.
Like I said, it depends on the buyer. I would say maybe it's actually not as high as I would think, but probably about 50% do temporary buy downs. Usually people really just like the permanent one just because it feels safer. On my personal home, I did a 3-2-1 buy down. So I had the builder pay me a lot of money to do a 3-2-1 buy down on my home. And that basically buys it down 3% the first year. So right now I locked at a 5.6. I'm at a 2.6 right now, paying as if I'm at a 2.6. Next year it goes up at 3. Next year after that goes up to a 4. And then after that goes up to 5.
Yeah.
So that's what I did. I recommend that to all my clients. It's just pretty good.
Yeah. So let's dive further into that, because, I mean, I heard 2.6, and you told somebody that they could be paying a mortgage payment of a 2.6 mortgage. You would fight someone for that number. That's
and I didn't buy my home 2 years ago either. I bought it 5 months ago, 6 months ago. So it's possible, guys.
Yeah. So basically, there's a couple of different versions of the temporary buy down. So exactly what Alex, what you've just been talking about, of just that it's that basically it's not actually dropping your interest rate, but it's doing it as if you're making that same payment. So basically, it's the seller sets a chunk of cash aside, and that chunk of cash offsets your payment so that it's as if you're paying less. So there's, and depending on the amount of concessions that you're able to get from the seller, depends on kind of which level of buy down you can do. Like the very cheapest one is called a 1.0 buy down, which basically for the first year, it makes it as if your payment is on an interest rate 1% less. So let's say your actual payment, which this is not an ARM, this is a fixed rate mortgage, so your actual interest rate doesn't change. So let's say your actual interest rate is 7%. Regardless of the buy down, your interest rate is 7%. That's the one that's going to be in your loan documents. That's the one that, that is what your loan is at. But let's say you have a 1.0 buy down, so a 1 year buy down. Your payments for that first year will be representative of making a payment at a 6% rather than a 7%. And then after that year, it would revert back to a 7%. And so there's 1 year, there's like a 1-1 where it drops it by 1% for 2 years, one after the other. There's a 2-1 where it drops it by 2% and then 1%. And then the king of all temporary buy downs, like Alex was talking about, is the 3-2-1. So the first year you're paying a payment of 3% less, 2%, 1%, and then it reverts back. And again, I mean, call it the optimist in me, which in this market I'm surprised I still have any. But I definitely don't see us being in the same rate environment that we're currently in 3 years' time or even 2 years' time. So the likelihood will be that will be opportunities to refinance and get to make that temporary rate buy down permanent. And so that you are, you're not just paying a 6% for a year, you're not just paying a 6% for 2 years, but that you can refinance and have that lower payment continue. So, yeah, it is an option that can really help home buyers that are in a tough situation. Maybe right now they're just really strapped for cash with interest rates high, with credit card rates high, with everything under the sun high, from grocery store stuff to gas to anything, right? And so it can help provide the means to still get a home and not be just chucking tons of money into it. So,
yeah. So let's go through a little bit about payments. What are payments looking like?
Yeah. So let's hop in and run through an example of like a rate buy down. So let's say we're looking at and we'll run through some different scenarios, right? So let's say we're looking at like a $400,000 house. And we'll put in the minimum down, right? And so let's say your payment's going to be around $2,700 a month before taxes and insurance. Let's say it's about $3,000 a month after taxes and insurance. So $3,000 a month is kind of what we'll be looking like, and so let's say that's kind of using a FICO of about 760 and saying we're about a 7.5% rate or a 7.91 APR. So using those numbers would be around kind of a $3,000 a month payment. And let's say the seller's willing to come down a little bit. They're willing to give you some back. And so let's say you can make two choices. You can either say, all right, seller, I'll buy your house, but I want to buy it for $10,000 cheaper, right? And so I was like, all right, fine. I'll drop it down to $390, right? The savings of dropping your home price, so dropping your loan amount, is what it's going to end up being. All other things the same. The difference is going to be $60, $70 difference. The payment, the difference of dropping kind of your principal payment actually doesn't make that big a dent in what your monthly payment is going to be when it's just like 10,000, 20,000, 30,000. It's not going to be a huge difference.
So your payment before the drop was how much?
About 3,000.
Okay, and then your payment after the $10,000 drop was how much?
About 2,940.
So $10,000 reduction, and that goes the same for increases too. So if it's $10,000 more expensive, it's only changing your payments by $70 a month.
Yeah,
at like pretty much the most.
Yeah, exactly. So it's really not going to make that big difference. And so, both, on this case, if you're looking at, a $400,000 house and you really love a house that's 410, like it's not really going to massively break your bank to be like, all right, go for the house you love, right?
$10,000 home sounds a lot more expensive, but in terms of payments, it's really doesn't make a dent.
And it's mainly, this is over a 30-year period, right? And so small differences really get washed out mostly over when you're looking at it over a broad period of time. So the other option, right, instead of having the seller come down by that 10,000, is if that seller is willing to give you that 10,000 in concessions, you keep the purchase price the same, still at 400,000. The seller still gets the exact same amount of money as he would if you did the 390, but you're getting $10,000 concessions back, and you can use that $10,000 to do a temporary rate buy down, and that would be enough. So for that purchase price and everything, you could do a 2-1 buy down like the one that we were talking about, and still have about $1,500 to use towards your closing costs. And the difference in payment, that first year where it drops it by 2%, that would drop your payment by $500. And the second year would drop your payment by $250. So the difference in that, right, of dropping the purchase price by 10,000 versus using those 10,000 as concessions for the temporary buy down is $440. So that's a lot of cash. That's like a car payment difference of like how much you'd be saving on a month-to-month basis. Now there is always the inherent risk of what if rates don't come like crashing down during that time. So I think it is still important that you're making sure you're buying within your means and not stretching yourself way too thin. But it is a very powerful tool to be able to get in a home you love, and especially if right now in this current market is you're strapped a little bit tight. This is a powerful tool you can use to give yourself a little bit of extra leverage.
Yeah. So the way you should be looking at this is like, okay, I can still afford my 7% mortgage payment, whatever the case is. I can still afford it, but I just so happen to get this really awesome buy down to where my payments aren't, like a 7%. So think of it like it's just gravy on top, not necessarily like you're using that in order to afford the home.
Mm-hmm. Exactly. And from a mortgage perspective, you still have to qualify for the top rate. So, when it comes to, we have to review credit, we have to review income and debts and things like that. That doesn't change at all with the temporary buy down. But yeah, like it's just a sweet gravy, like Alex was talking about, having that extra $500 in your pocket, the extra $250 in your pocket after the second year, right? And
one thing, because I know we have investors that watch this, you're not able to do a temporary buy down for an investor, are you?
I think it's going to depend on I don't believe so, but I can double check that. It generally is just done for primary residences, but I can double check that for sure.
Sick.
So. But yeah, it's it is really important as well. Like, and we've talked about this before, that that you are kind of looking to, you know, you want to make sure, we don't want you to be house poor or anything like that. We want you to be able to be super stoked about the house that you're buying. And so, you know, looking at buying within kind of the means within with the top rate is really important as well. So,
Yep. And the other thing to look at too is and we're going to continue to move forward with this, don't you worry, but I also want to present you guys basement apartments, right? So if you purchase a home, let's say a single family home that has a basement apartment downstairs, or a mother-in-law, whatever you want to call it. Basically, it has a kitchen, it has its own entrance, or maybe you're sharing an entrance, whatever the case is, but it has also bedrooms, right? It's its own living space, its own laundry area, whatever, like all that, right? You buy a home like that. Let's just say this home, for example. So I'm actually going to pull this home up on the screen. This home costs $695,000. So a pretty expensive home, right? And you're probably going to think your mortgage is going to be super expensive. Well, you're right. It's going to be $5,100, right? Assuming you're putting down 3.5%, which you're going FHA, interest rate 7%. You're going to be paying $5,100 a month, which is pretty expensive. And this also includes like your escrows as well, which is like taxes and stuff. So that's pretty expensive. But guess what? You can actually rent out the basement, just have someone living with you, whether it's a family member, a friend, or just some random person you found on Craigslist. You can have,
yeah.
maybe not Craigslist, go KSL or Facebook at least.
There's other options. Don't stoop that low.
But this home, I mean, with its current finishes and everything, you probably rent it out for, I don't know, $1,500 on the downstairs. So we'll just say $1,500 because it's a round number. You know, subtract that by $5,100, you're $3,600 a month. Okay, which is still pretty expensive. But guess what? You can also do. You can ask for a buy down. Okay, let's go 2-1 buy down. How much would that cost on a $695,000 home?
Let me pull it up right now.
Sick.
And then just to clarify our earlier conversation. So yeah, you can do a temporary rate buy down on government loans as well. So like FHA and VA. Those obviously are only owner occupied loans, so wouldn't come into play with an investment. But multi-unit is possible. But with a conventional, you can do a temporary rate buy down for a primary or a secondary home. Investment home, no. So yeah, investment properties would not work, but it doesn't necessarily have to be a primary residence. You could do it on a secondary home. So,
and with the secondary home, you have to live in it 2 weeks out of the year, right?
Yeah. So it has to be a true secondary. It can't be just a straight investment property. So.
And I've always been curious, how does the lender know if you've lived in it for 2 weeks out of the year?
I mean, a lot of it comes down to honor system. Like I don't commit fraud. That's kind of my that's my policy. So like when you're buying it as a primary residence, it should be a primary residence. You don't want to be in a situation where you claim like you're buying a primary residence and then 2 weeks later you buy a primary residence. Like it's just don't commit fraud. Like just make sure that you're being good. But yeah, I don't know. I'm not going to be showing up at your front door and see what you're doing. But, yeah, it's
honor system, guys.
Yeah,
be honorable.
Yeah, be honorable. Honorable is good.
But
what was the purchase price you were saying?
$695.
$695. Yeah.
Yep.
And how much down?
3.5.
Okay, perfect.
So, for example, if you put down an extra $10,000 on this home, your payments would only go down like $70 a month. Yeah. So it's like, usually it's good to keep money in your pocket rather than throwing it all down in a home, but it just kind of depends on your situation.
So if we're at, you're saying 7% interest rate, right?
Yeah.
Because we're looking at FHA. So FHA, so generally when we're doing you're looking at a multi-unit property, which are awesome ways of being able to offset your mortgage payment because you have someone else that's helping pay for your mortgage, right? So If you're doing a conventional loan, generally you're going to need at least 15% down.
This is a single family. It's not a multi-unit.
Oh, okay.
Yeah. It
There we
just
go.
has a basement apartment.
There we go.
There you
Okay,
go.
Never mind. Never mind. Take that back. Okay. Well, either way, multi-unit or single family, 3.5% down, you can deal with an FHA loan. So, so single family, totally fine. For a 2-1 buy down, we'd be looking at it'd be 15,600. So
Your payments with that 2-1 buy down is going to be just under $4,300. Okay, and that's without renting it out. Okay, now you throw a renter in there for the same $1,500. Now you're closer to $2,700, which is the same amount we were talking about for a $400,000 home.
Yep.
So
you're buying a $250,000 house more, or
$390,000,
yeah,
almost $300,000.
And paying the same as yeah. So
also, I'm going to teach you a principle.
Go ahead.
So when you're buying a home, right, townhome, condo, single family, there's different prices, right? Now we're not going to go through the nitty gritty of which one appreciates faster, which one appreciates more on average. We're just going to say $400,000 home, average appreciation rate in Utah is about 6%. We're going to say 5 just to be safe and easier math. So in 1 year or 5 years, right? 1 year you're going to be making on a $400,000 home $20,000, okay? And your payments are $2,700 versus if you bought, let's just say this home, for example, your payments are still $2,700, but it's a $700,000 home. So 5% on $700,000, you're making $35,000 instead of $20,000, and you're paying the same payment.
And you're writing off interest and stuff on your taxes as well.
Yep. So this is kind of what we're getting into when we say, hey, don't look too much about like your payments because we can help with that. There's ways to get around this kind of stuff. Mm-hmm. And like I said, we can help you with that. You're not alone in this. That's what we're here for. But anyway, sorry don't want to beat a dead horse for too long. What else you got?
Yeah. So the other thing that makes a difference in your monthly payment is HOA versus no HOA.
Yep.
So I feel like, what are your feelings on HOA, by the way?
Oh God. I live in one. They suck. I hate them.
I hate HOAs.
I think they have their place. They have their place. Condo buildings, great. I mean, you kind of need one in that situation. Townhomes, okay, for sure. HOA, totally reasonable. Once I am not sharing walls with other people, and I'm not sharing grass with other people, fuck off. Get out of here. That's my house. Especially, I hate it when I had this happen at my place. I left my garbage can in my driveway, not impeding anyone at all, just in my driveway, just because like it's easier to throw trash away instead of having to open my garage or whatever. I got a letter. This was like the day after garbage day. Hey, put your trash inside. I'm like, dude, I don't even have space in my garage for that crap. Like, what do you want? Get out of my hair. That kind of stuff pisses me off. Especially when I'm just going to stop. I can go on all day, but they piss me off.
I hate, and you have, it's really annoying. You have HOAs that have restrictions on who can like rent their house and like who can't, which is a huge bummer for people who are trying to purchase like a property to eventually use as an investment home.
Some of them are even worried about pets.
Yeah.
You can't have a certain size pet. I'm like, dude, it's my house. I'm going to do whatever I want in my house.
I'd put down a chunk of cash for this house. I mean, yeah, I don't know. One of the awesome parts of owning a home versus renting a home, right, is that it's your place and you can do what you want with it. So I hate that HOAs can just come in and tell you what to do with your property. But yeah, when it's like a condo complex, it definitely makes sense. There's normally like a lot of other things that they're doing as well.
Maintenance and stuff. They'll take care of the roof, that kind of stuff.
Sure. Well, you've got a shared roof right across you. So, things like that make sense. And generally when it's a condo as well, your homeowner's insurance is kind of built into that HOA as well is what's often the case. And so, that's also something to be aware of. But it's when it's your own home that drives me nuts. But the thing to be aware of as well is, so kind of with an HOA, is being aware that, as you're getting lower on like purchase price of a property, generally that comes with HOA, right? Like the lower you move down generally means higher HOA is what I normally see, right?
Unless you want to move into a flip that hasn't been flipped yet, then maybe you can get away with like a single family home that's not an HOA at a lower price. But then, it's probably a meth house or pretty close to it, and you don't want to live in it.
Yeah, it's probably not.
So, yeah, like you said,
maybe the Craigslist rented.
Right. Usually, like if you're 400K and below, especially in Utah, you're going to be townhome, condo, or like a really small single family home, or a single family home that needs to be flipped, but you don't want to live in that. So, anyways.
Yeah. So, it's, a lot of times when you're looking at the purchase price, you might be like, oh my gosh, this is so much cheaper than this other house, right? And it's important to realize it might not be, because one might have an HOA and one might not, and it can make a big difference in price. So, for instance, let's say you've got like a $400,000 house, you're putting the minimum down of 3% as a first-time home buyer. You got a 760 credit score, and let's say your interest rate's around like 7.5 or something like that, with a 7.91 APR. So, estimating taxes and insurance and everything like that, let's say again, kind of your monthly payments around kind of the $3,000 mark. Well, let's say you drop that purchase price and you find another property that's quite a bit cheaper. You find it a place that's like 370. You got about $30,000 in difference, which sounds like a big difference in purchase price. But you add a $200 HOA in there, and that monthly payment is like almost the exact same.
Sometimes it'll be more too, because that'll be like an older townhome or an older condo. And usually HOAs don't reduce the HOA payments. They typically increase them because costs increase.
Yeah.
Now you got to start planning for a roof. So they have to increase the HOA cost, so they have reserve, etc. So usually your HOA payments are actually going to be a little bit more in that kind of a situation.
Exactly. And then there's other costs that are associated with HOAs as well, like HOA transfer fees and things like that. Do you want to explain what that is?
Leeches, I tell you. So HOA transfer fees, they can be very expensive. They can be anywhere from 1% to $500 of, the home, right? So for example, if you sell a $600,000 home and the HOA transfer fee is 1%, they're going to take $6,000 either from you or the buyer. Or, if you are the buyer, they're going to take it from you or the seller. Okay. Or it can be really low, like a normal $500 fee, because I couldn't imagine paperwork costs any more than $500 to move around. So
what are you paying for them every month?
That's the whole point of the monthly. Don't get me started. Anyways, they can be very expensive. Usually you're going to be anywhere from 0.25% to 0.5% of the purchase price. Either way, it's a lot more money than anyone really wants to pay.
Yeah.
But yeah, it's you got that too.
Exactly. So that's money that's going to be included in your closing costs, right? So let's say we are talking like
Sorry, one thing that you totally skirted past is APR versus like the actual interest rate being charged. What's the difference?
Yeah. So the difference, the interest rate, is like, that's the percentage you're paying on the home. The APR is kind of includes other costs and fees. So kind of looking at, hey, if we rolled like all like the things that you're paying with like closing costs, so like you're paying like title, you're paying, your escrows and different things like that from the outset. And so it kind of rolls it in. The interest rate is the one that's really important. I feel like APR might just kind of move out of usage. I say APR mostly because I'm legally bound to. But really it's, but if you are like, for instance, if you do see a vastly different interest rate and APR, look over your loan documents. Anybody that's doing your loan for you should be explaining what you're paying for in your closing costs. And so you want to make sure that there's not a ton of origination fees and things like that. like thousands of origination fees that are being charged. So the APR can kind of point you to if there's something maybe you need to take a second look at on your loan documents. When in doubt, ask your loan officer and ask, they'll provide you with a loan estimate as soon as you go on a contract, and then you have a closing disclosure that you sign before closing and again at closing. And your loan officer should, if you have any questions of anything that's on those kind of documents, make sure that you understand what every line item is. You should understand, what you're paying for. So, but that's basically all it is. It kind of like just rolls kind of the other costs and stuff associated into the home and saying, hey, what would be like the interest rate if everything else is checked in? But the actual interest rate that you're paying on the home, that's your mortgage rate. APR is different. So does that make sense?
Yeah, totally.
Yeah. So that's mainly what that is. Don't remember. What were we at?
We were talking about something about payments and purchase price.
Yeah.
HOA.
Yeah, HOA. Basically, yeah, just be aware, because if you're paying, if you are paying kind of like what Alex was saying, that you can be paying up to like 1%, like $6,000, like that $6,000 difference in like a difference in like a temporary buy down, right, could be dropping your monthly payment by like
$500 a month in 1 year.
$500. Yeah, exactly. So, you're actually, let's say you have seller concessions, right? But you have an HOA transfer fee. That's $6,000 of, seller concessions that you can't use, right? That's being paid off as part of your closing costs. So just be aware, HOAs, when you're looking at home prices, make sure that really what you want to be finding out is, and I said this kind of from the outset, is what is your monthly payment going to be looking like, and rather than exactly what is, every time I speak with someone about doing a loan, kind of one of the first questions that comes out my mouth is, okay, where are we looking at for your monthly payment? What have you been kind of like budgeting? Like, what's kind of your range of what you could feasibly pay for each month? And that kind of gives me a target of what we should be looking at for a purchase price of a house, rather than kind of saying, okay, kind of, and this, we do talk about this as well, but what house price are you looking for? Because when with things like HOA, with things like seller buy downs, those two questions could be vastly different. So it's monthly payment with HOA can vary a lot. So
that makes sense. Okay, so I guess let's go through like a crazy scenario. Let's say we kind of already did, actually. I don't even think we need to do that in terms of like how much the payment difference can be from a higher purchase price to a lower purchase price. I don't know. What else do you got for us, Oscar?
Yeah, I mean, we can run through it. Like, let's say we're talking about both. Let's say there's one that has like an HOA and a buy down, and just see how vastly different kind of these ones are. Unless you have something else you want to hop into.
Not in particular.
All right. So let's say we're looking at like a $450,000 house. You put in the minimum down, and let's say we're still at kind of the 7.91 APR rate with a 760 credit score and everything like that. So monthly payment on something like that with estimated taxes, insurance, and everything would be around like $33.50. So, and then you see this other house that has that's $80,000 less, so $370,000. Your payment's obviously going to be a lot less on that house. It's $80,000 less, and so, but let's say that house has a $200 homeowners insurance. So, just with not homeowners insurance, not homeowners insurance, HOA. Sorry, too many H words. So even with the HOA, you'd still be about $400 less. for your payment each month. But the thing is seller buy downs, as we've talked about before, can drop your monthly payment by a vast amount. And so you could be paying less. So if you had a 2-1 buy down on that $450,000 property, you'd be paying, at least for the first year, like $200 less a month than that $80,000 less house. So just when you're looking at, all these different options, know that there are ways that you can use to get the best deal. We've talked about credit. Credit's obviously important. The increasing your credit score is definitely going to help your monthly payment. Making sure that you are, keeping your other debts lower is definitely going to be able to help you afford a home and be able to take care of, your bills and everything and expenses every month. But then also just tips and tricks like, what to watch out for when it comes to an HOA on a property, what to watch out for when you have some seller concessions, like, oh, what can we do with this in order to help me the best? And looking at temporary buy down instead of a permanent buy down, or things like, what Alex was talking about, where, maybe you want to look at a house that has a basement, or it has like a mother-in-law apartment that you could rent out, or that it's a duplex or something like that. Those different methods in this environment can slash down your monthly payment by a lot and be able to be the difference from renting, where you are paying 100% interest because none of it is going into back into your pocket, and being a homeowner, where you can be able to start creating appreciation, things like that. And we were talking right before this that we've seen home prices actually start going up, right? That the time to get appreciation is still very much, it's there for the taking.
Yeah, and even long term, I mean, I'm gonna get off in the weeds here, but let's just say the market's gonna crash, right? Whatever reason, market's gonna crash. I don't know, 10%, something stupid, right? Does it really matter? I mean, you can make the payments, you own the home, you're going to live in it for 5 to 10 years. It's you're not going to sell it like a year after you move into it. It doesn't really matter what the market does, right? Either way, long term, you're going to be getting appreciation. You can't really look at what's going to happen short term. You just got to make sure you got your 6 covered, right? You know what you're doing. You can make your payments. You can afford everything, right? In terms of cars and food and fun and stuff. Don't make a poor decision, right? Don't make an impulse decision, but also don't worry too much about what's happening short term. You got to be thinking long term, because real estate investing, real estate purchases, anything real estate, investing in general really is long term, not tomorrow, not next month. It's what's going to happen in 10 years. So that's kind of how the mindset you got to have. But
anybody that's kind of looking to just make a quick buck in real estate, it's not how it works. But it is establishing kind of the means of creating passive income that is going to benefit you for years to come, and can, like, when you're retired, right? You're going to be very glad that you bought that property forever ago, right?
Yep.
And really, there are 3 things that mortgage interest rates can do, right? They can either go up, or they can stay the same, or they can go down, right? And so, most likely they're going to go down. But let's look over those scenarios, right? If you really want to buy a house and you can afford to buy a house right now, and you believe interest rates are, if interest rates go up, then right now is the best time to buy a house, right? Otherwise, you're going to be renting for a long time, and renting actually increases. It's crazy, but rent increases. And so actually it's going to be more and more expensive for you to rent in the future, rather than locking in a mortgage rate right now. Or let's say that, rates are going to stay the same, which they never stay the same, but let's say they stay the same, then, what is the benefit of waiting to buy a house in the future if mortgage rates are going to be the same in the future than they are right now, right? Let's say 3 years down the line, we're still going to be, in the sevens range that we're at right now. You are, and let's say, you're waiting in that regard, right? You don't own a home, your rent's more expensive, and you missed out on appreciation. And you're not in a better situation a couple years down the line of buying than you are currently. And then the last one, let's say rates do decrease. That's great because that means you can refinance in the future. You can take advantage of that lower payment. You can enjoy that lower rate and still have the home that you wanted and have been able to enjoy the home in the meantime, and gain the appreciation that would have come with it. So my kind of view is, even though we have expectations of what mortgage rates will do, regardless, if you're in a situation where you can buy a house and you want to be a homeowner, it makes sense to buy. Like it really does. There's not really, it doesn't really make sense to just hold on in any regard. So
yeah, kind of piggybacking off of that, like best and worst case scenarios, right? Like ideally what we want to happen to you, right? You buy a home, you get a 3-2-1 buy down ideally. And then a year and a half, maybe 2 years at most, rates start coming down. Then you were able to take advantage of the lower home prices. You're able to take advantage of a 3-2-1 buy down, which is killer. You're actually going to have a lower rate doing that than you will when you refi, but most likely. But you get to take advantage of home prices. You get a refi into a permanent, pretty good rate. And typically when interest rates go down, prices tend to go up. So now you get bonus appreciation, right? That's the perfect ideal. That's exactly what we want to happen. Now, worst case scenario, let's say you buy a home, you get a 2-1 buy down, okay? And then 2-3 years down the line, you're back to your normal rate that you can, hopefully you made a good enough decision to where you can actually afford every month, right? You're back to your normal rate. It never changes, but rates increase, okay? You kind of not necessarily shot yourself in the foot, but mistimed, I guess you could say. Rates end up increasing and you can't refi at that moment, right? But hopefully down the road you're able to refi. But still, either way, you're still going to get appreciation. Granted, it's going to be a little bit slower. But yeah, I mean, that's like the worst case scenario. You're just stuck with the rate that you were approved for to begin with.
Yeah. Which if you could afford it, then
it's not really a problem. I mean, ideally we don't want that.
Yeah.
But that's really worst case scenario. And hopefully you bought a home that has a basement apartment to where you could just, rent it out. So you're not having to eat a $5,100 mortgage every month. I'm just kidding. But anyways, there's good and bad. There's good scenarios. There's bad scenarios. It just depends on how you feel.
Yeah.
Usually buying a home sooner is, I mean, we've talked about this. We beat this horse dead already, but
yeah, we have.
Buying a home sooner is going to save you money down the road. That's usually the way it goes. There's only really been a couple times where that hasn't been true. Like if you bought a home in 2008, if you waited 5 years, you'd be in a better situation. But like we also, to be in that kind of a situation, we need another 2008. So anyways, long term, even if you bought a home in 2008, 10, 15 years down the road, you're still happy you did because you still got it at a great time. Anyways, I don't got anything else for them. What do you got?
No, I think we're about good. Just know that there are options out there. And we didn't even delve into other things like, aside from conventional loans, right? There are there's FHA loans that have lower interest rates, that generally have lower monthly payments, especially if your credit score isn't, high 700s. If you're a veteran or active service in the military, there are VA loans. I love VA loans. They're awesome. They have lower interest rates. They don't have mortgage insurance, so your monthly payments are going to be less. There are USDA loans, which are rural loans. They generally have a lower monthly payment as well. They're a little bit trickier, so in the current market, but they are an option that's on the table. So, there are lots of ways that we can delve in deeper to see the limits that we can get to. And then there's also, assumable loans, which we can delve into that more in another time.
I say let's delve into it now.
Let's do it right now. Yeah, we got time. So Alex, assumable loan.
Assumable loans, they are very difficult to find.
Yes.
Um,
Everybody wants them.
Everybody wants them, and they can be not only hard to find, but expensive to purchase because let's say someone bought their home a little while back, got a really good price on it, and now it's worth, let's just say they bought it for $400,000, now it's worth $600,000, and they owe $350,000. Okay, but they have like a 2% interest rate. That's pretty good. Your 2% on $350,000, your payments are going to be like, I don't know, $1,400 a month or something. So that's pretty solid. But guess what? Now you have to bring to the table $200,000, right? $250,000 because their home's worth $600,000. You have to bring in a lot of money to meet that difference, which is really the downside of it. But still, you're getting a pretty killer rate. So if you have that kind of a down payment, or if you have that kind of money, it could be beneficial.
So the way it works is basically, it doesn't really work with conventional loans. So it's just if there's like a government loan, so like an FHA, VA loan, things like that. And basically you are taking over the previous person's loan. So that's not done through your general mortgage lender. It's not done through like, I can't do it. It will be done through the lender that initially issued the loan. So, let's say there's a property that has like the loan that is currently on that property is an assumable loan. Let's say it was an FHA or a VA loan or whatever. You would get pre-approved with the lender that has that loan to take over that, and then you'd be able to get that whatever interest rate is on that home currently. Which if that loan got started in 2020, 2021, can be killer, but can be a great interest rate. But again, a lot of times you need to be able to fork up a lot of cash, and that they're in high demand. So it'd be pretty tough to find one. But if you find one, or as well, just making sure that your real estate agent knows what to be looking out for as well. There's a lot of real estate agents out there that I don't think know how to look if that's a possibility, and they might be selling a home where that's not where that's available, but they're not aware of it. And so, someone awesome like Alex or to be able to find out whether that is an option, because that can be a game changer on your monthly payment for sure.
Mm-hmm. And it could be a game changer if you're selling your home, the amount of buyers that are interested in it. So quite a lot of variables, and there's a lot of things to think about, but assumable loans, assuming you don't have to put down $500,000 to assume it, they're pretty solid.
Yeah, exactly. So if it's an option, that is another possibility of really slashing down your monthly payment in this market. It's going to be a lot less common than looking for some of the things we've been talking about already. But it exists out there for sure.
Yeah.
So,
but we have nothing else for you.
Nope.
We are all tapped out, but let us know the next topic you guys want us to cover. And also please subscribe. We're trying to reach 1 million subscribers. We missed our mark of 1 million this week. Hopefully next week we'll hit it.
Yeah.
We're just a little short, but make sure you guys subscribe, let us know what you guys want us to cover next time. Follow us on our social medias, and we'll see you next time. Thank you for your time. Peace out.